Invoice and payment stages.
Oh, that was your father I was talking to on the phone.
Well,
He wanted to know whether you are getting the relevant information that you need.
everything is absolutely relevant.
I said the same thing to him.
Where is he anyway?
He's in a meeting out of town. He'll be back in the evening.
That's all right. What step are we going to take next?
You tell me.
Let's see. We started with the inquiry stage, then moved to order stage, and now we've just concluded the delivery of goods stage. According to the flowchart that you gave me earlier, this means that we are moving on to invoice stage.
That is correct.
What I don't understand is that we already discussed the pro forma invoice when talking about the inquiry stage. Why are we discussing it again?
Now, that is a very normal question that I get in accounting. Before I answer you, I want you to first remind me of what we said about pro forma invoice.
We said that pro forma invoice is a polite request to the buyer to pay for the goods first before the goods are delivered to him. We also said that it is made when the seller does not trust the creditworthiness of the buyer.
Excellent. Now, what I want to talk about is an invoice and not a pro forma invoice. An invoice is a document that the seller sends to the buyer to demand for payment of goods sold.
Wait a minute. If I am getting you right, you are saying that the goods have already reached the buyer?
Yes, let me take you back to the beginning. The buyer inquires about the goods that he wants to buy,
Yes.
and the seller responds by sending a price list, a catalog, or a quotation.
Yes, we already discussed that. And we said that the buyer examines the quotation, catalog, or price list properly and decides which goods he wants to order for, after which he places the order.
Correct. The seller then starts determining the creditworthiness of the buyer. The pro forma invoice is only sent if the buyer lacks creditworthiness.
Yes.
If, on the other hand, it is determined that the buyer is able to pay for the goods, then the seller makes arrangements to send the goods to the buyer.
Aha. Up to this point, the buyer has not paid for the goods, even though he is able to pay.
Great. I am glad that you are staying with me. Now, the goods have finally reached the buyer, but the seller has not received payment for the goods yet. So, what does he do?
He sends an invoice to demand for payment. Now I have understood you perfectly.
Perfect. Then we can move on. An invoice will contain the description of the goods already supplied, their nature, their quantity, price, and condition of sale and delivery.
Is this document of any importance to the buyer?
Yes, it is. The buyer can use it as an evidence that indeed there was a business transaction between him and the seller.
I see. And what does the buyer do after receiving the invoice?
He goes ahead to make arrangements on how to pay the money.
What if some goods had been returned because they were damaged, excess, or for any other reason that we had mentioned earlier?
Oh, that is another excellent question. So before a buyer pays up the money, he has to study the invoice to see if it has any errors. These errors may be caused by wrong arithmetics, damaged goods, returned goods, or due to excess goods. If the invoice contains no errors, he pays promptly. If it has errors, then the seller has to be notified of the mistakes immediately.
And then what happens?
The seller issues a document depending on the kind of error made.
Very interesting.
Interesting indeed. Remember, we are discussing documents used in home trade. So expect nothing but documents every step of the way.
Noted.
So the first document is called a credit note, and it is sent by the seller to the buyer to correct an overcharge error in the invoice.
So in the credit note, the seller seeks to reduce the cost of the goods by the overcharged amount?
Yes. Credit note is also used when goods were returned to the seller and the seller is not in a position to replace them.
Okay.
The second document is called the debit note.
What is the use?
The seller sends this to the buyer in case the goods were undercharged in the invoice. It shows the additional amount that the buyer is expected to pay.
I see. What would cause an undercharge anyway?
Now, for one, if there was an error in the calculations of the prices. Number 2, it may be that the buyer received excess goods by mistake, but does not want to return them to the seller, or he is not even aware that he has excess goods.
Understood.
So sometimes when an invoice is issued, the buyer does not pay for the goods immediately. He may take some time, say a month, before he gets to pay for the goods.
That's understandable, especially if he did not have enough money at that particular time.
Yes. Sometimes though, the buyer even pays for the goods partly. In such cases, the buyer and the seller come to an agreement that records of such transactions will be kept to ensure that the buyer gets to know what he is still owing the seller. Are we together?
Yes, we are.
Good. Now, these records are known as statements of account and can be defined as a summary of all the transactions between a buyer and a seller that have taken place over a given period of time. They are sent by the seller to the buyer on a monthly basis so that the buyer knows what he is still owing the business. On the other hand, the seller can use a statement of account to assess the creditworthiness of the buyer in future.
Obviously, if I had a customer who does not pay up his debts, then I wouldn't give him goods on credit in future.
Yep, I am with you on that.
So, what does a statement of account look like?
Well, it contains the balance brought forward, which is the previous balance the buyer owed to the seller and is now being carried forward to the next billing period.
I got it.
Then we have the dates of the transactions and the amounts of the goods purchased. The next column will record any payment already made, and finally the balance at the end. It also contains any goods returned. And now, finally, let us go to the last stage of the transaction process.
The payment stage.
Yes, the payment stage. Here, a receipt is issued in the case of a cash transaction, and the buyer is given the goods. In the case of a credit transaction, the payment is done after the invoice has been received.
So, a receipt is proof that payment has been made.
Exactly. It is a very important document for recording information in books of account, but I will not go into that just yet.
At least, I know how it looks like. It contains the name of the seller, address of the seller, the date of the transaction, receipt number, the amount received, the signature of the seller, and a stamp. Did I get it correctly?
All of it. Sometimes, when the payment is above a certain amount, a revenue stamp is required to be fixed on the receipt. As such, large amounts attract taxation from the government.
I see.
And that is everything on documents used in home trade.
I did not know that trade can be such an elaborate topic, with so many areas to learn from.
Now you know, and we are not even finished. For now, I want you to go home and process everything that we have talked about today. When you are sure that you have understood them all, you can come back so that we get to discuss something else. How about that?
It is a deal.
All right then, run along.
Thank you so much, Mr. Joseph. It was nice meeting you.
And you as well.